What is the best moving average from all these choices for your trading? Well, it depends. If you want to follow the trend, then usually the EMAs are your best option, since they're the most aggressive and fastest to react to the price action. Whereas at the opposite end of the scale, if you want to find support and resistance zones, usually the SMAs are the best choice, since they're slow to react, but they do smooth out all that noise. For example, here where we move from sideways ranging price action to upwards trending price action, the faster acting green EMA line responds and curls up more quickly than the red slower responding SMA line, getting us into that long trade much more quickly and staying in that trend. Whereas up the top here, the SMA line in red acts as a resistance, whereas the EMA line below doesn't really offer a signal. So to help you choose the best one, I will compare the SMAs, the EMAs, and several other moving averages so that you can understand the subtle differences between each one and make sure you're applying these correctly depending on the different types of price action. If that sounds interesting to you, let's dive in. The best place to start to understand the differences between all these choices is the most basic simple moving average, or SMA, because understanding how this is calculated and the underlying drivers helps explain why this is the most smooth and slowest to react. If you just want to apply the moving averages, feel free to skip past this calculation demo using the chapters below. Now, to explain how this works, and I'm using this example from the Bitcoin chart with the last 10 days of price action in August 24, where each candle represents one day. And here I have the candle closing prices plotted out for each day. And this is the SMA calculation, which is simply the closing price for each day divided by the number of days. And in this example, I'm going to use the look back period of 5 days. So N equals 5. And to calculate the SMA line for the first line, day 5, we just plug in these values. So the SMA equals the price on day 1, 54,000, plus the price on day 2, 55, plus day 3, 56, plus day 4, 57,000, plus day 5, 56,500. And all that is divided by the number of days, where N equals 5, so we put 5 in there. Now, if we calculate that through, that comes to 278,500 divided by 5, which equals 55,700. So that is our SMA value on day 5. So we can put that in there, 55,700. We can also now plot that value on day 5, which is roughly around here. Now we use the same formula and we just calculate all the values again by moving forward one day and shifting each of the values. So I'll just calculate that now and update the chart. And now it's just a simple case of adding those calculations onto the chart and joining up the line to see where is our SMA line, which you can now see clearly on the chart. Now that you understand the calculation logic of the moving averages, we can review the simple moving average and draw out some of the key insights of how to use this. So, as we saw on the whiteboard, the simple moving average is really quite straightforward to calculate, and this is one of the reasons it's so popular, just the simplicity aspect. So, as we saw in the formula, by definition, it gives an equal weight to both the older prices and the newer prices, since essentially it has a weighting of 1 on every single price point. So that's the reason why the SMA is the most slow to respond to recent price action. Now, something you'll see is that if you increase the number of periods, so let's say the SMA 100 versus the SMA 20, then it will smooth out the SMA line even further, exacerbating that smoothness or slowness to react. So if we look on the chart, here I have the SMA 50 line in bright green, and now if I turn on the SMA 100 line in the mid shade of green, you can see here where there was a rally up in prices, the bright green SMA 50 line is the fastest to react and has the steepest gradient. And then the SMA 100 line, you see, is slower to curl up because it's smoothed out more by that longer time periods. And then if I turn on the SMA 200 line here in dark green, you can see this is even more smooth. You know, it's even slower to react to the latest price action. So those SMA 50, 100 and 200 lines are often the most commonly used, particularly in TradFi, and people often observe these as support and resistance levels that are respected. And we can see that on the Bitcoin chart. If I just turn off these and show the 50 line, you can see before this recent pump in Bitcoin in February, price was hugging that 50 line, and then it flipped that to support. We got this big move up over several weeks, but then not long later, you see the price action drops below the 50 line, comes back up here on the 24th, 23rd of April, and it's flipped that 50 line to resistance. And then here happens again in May, the 50 line gets flipped to support, then we get a bounce off it, then it kind of ranges for a while, and then in the most recent last 2 weeks, we've seen Bitcoin has struggled over and over to get above that 50 line, which has flipped back to resistance. So yeah, these are levels which are observed, although it tends to be more important on the higher time frames, like the daily and the weekly, which is why I was on the daily chart. And if you are looking in the indicator itself, in the SMA menu, I have selected the daily time frame. And you'll see a similar trend if you flip to the weekly, although on the lower time frames, it doesn't have such strong predictive power. And then the last point is that the SMA line can be just a very simple indicator of whether we're in an uptrend or a downtrend. And sometimes people will look at crosses between those lines to see whether that trend is shifting. And a common one is when the 50 crosses the 200, which is either called a golden or a death cross, depending if it's bullish or bearish. So if we turn on the 50 versus the 200 and scroll back in the price action in Bitcoin to between June and September, you'll see here there was a period of ranging price action. And then when this impulse started in October and we started to get the move up, you see here the brighter SMA 50 line crosses above the darker SMA 200 line, which is the golden cross. And then we get this very, very strong uptrend from around November, where Bitcoin was at around $30,000, and it continues all the way up to $70,000, and that 50 line stays permanently above the 200 line throughout this powerful upward trend. And arguably now that trend could be coming to an end, because clearly the Bitcoin price has shifted into ranging price action, and you can see the SMA 50 line curling over, coming down, and in the last few days the 50 line has crossed back underneath the SMA 200 line, which is called the death cross. So arguably this is the end of this ranging price action, and we may be shifting now into downwards price action. At the opposite end of the extreme, we have the EMA, or Exponential Moving Average. So let's look how this is constructed. And the idea with this is it's applying weights, but the way the formula is constructed means the weighting factor decreases exponentially. So again, this is trying to provide a stronger weighting to more recent price action, so the moving average line is more responsive. So with this, there are two components to the calculation. First of all, you have a multiplier with a formula of 2 divided by 1 plus the number of periods. So if you plug in 5, that comes to 0.33 recurring in this example. Then here is the main formula, which is the closing price minus the EMA on the previous day. Now, you may be thinking, hang on a minute, how can we calculate the EMA but have the EMA as an input? Well, the way to overcome this is that on the first line, we actually take the SMA as the first value and then input that here, and you'll see how it works through. So, on day 5, the EMA value for the first point on the moving average curve, we just take the SMA value we calculated earlier and plug that straight in here. So that's the EMA on day 5. Now we have the starting point, we can calculate the EMA for the next day 6. So if we apply the formula, the EMA on day 6 would equal the closing price on day 6, which is 55,000. 55,000 minus the EMA on the previous day, which is 55,700. 55,700 multiplied by our multiplier factor, multiplied by 0.33 recurring, plus the EMA on the previous day, 55,700. Now, if you multiply that through, that equals, this part is minus 233.33 recurring plus 55,700, and that equals 55,467. So that is our EMA value on day 6, which is that value there. So now we've got the first two values on the EMA line, we can plot those on here. So 55 is the same as the SMA value from earlier, and then the next point is 55,467, and that would actually be slightly below the previous SMA line, so it would be somewhere in there. And now, again, we just apply that formula and work our way down through the table, and we can plot on all of our exponential moving average points, plot those on the chart, like so, and connect up the lines. And there's our EMA line. So now we can compare the features of the simple moving average to the exponential moving average. And as we saw before, the EMA uses that exponential weighting factor as you go back in time, which means that the more recent price data has greater importance. And this yields several useful insights. The first being that generally the EMA is more reactive to the recent price action, which is what it's designed to do. So here I have the SMA line as before. This is the SMA 50 in green, and in blue I've added the EMA 50. Now if we go back and look at that big shift in trend from this ranging price action for Bitcoin in December, January, and then we saw that big impulse upwards trend starting here. Well, the SMA 50 line in green does react and start curling upwards, but you can clearly see that the blue EMA 50 line starts curling up before the SMA line does, and also it trends upwards much more sharply and at a steeper gradient. And on top of that, it's also above the SMA line because obviously it's more reactive. The second point is that the EMA line is more conservative in terms of a measure of price strength, because when you get that upwards trend and the EMA is reacting quickly, it's hugging closer to the price action. So, for example, halfway through that impulse, we got a bit of a pullback here. Now, let's say your trading strategy was that you would remain in your long position whenever price is above the moving average line. Well, this is more conservative because if this price had dipped a little bit lower and gone below the EMA line, then that's when you would have cut your long position and locked in your profit from down here to say up there. However, you would have cut that position before you would have cut it if you were using the SMA line, because obviously the EMA line is higher above the SMA line. So that's why during that uptrend, the EMA is more conservative, because you'd cut the position sooner during, if this had dipped below here during the uptrend. However, this works in the opposite way towards the end of the trend when the price action shifts to ranging and possibly downwards price action. Because at the top here, we can see in kind of April time, prices start coming down on Bitcoin from around 70,000 down to 60,000 and below. And of course, again, that EMA line is reacting more quickly. So here you can see the slower responding SMA line keeps going up while the EMA line starts curling down and dips underneath the SMA line. So under this scenario, when the trend shifts to the downside, if you were using the SMA strategy, you would actually get out of the trade earlier, because here you can see the candles dip below the green SMA line before they go below the EMA line. So what that means is at the end of the trend, the EMA line will actually keep you in the position a bit longer. So there are those trade-offs. To sum up, overall, most people would say that the EMA tends to be a better overall gauge of trend. The other point is that the differences between these two does become bigger when you're using a longer look back period, i.e. there'll be a bigger difference on the 100 versus say the 20 or 50. So let me show that here. Now I'm going to add on the SMA 100 line in darker green and the EMA 100 line in darker blue. So if you compare these, you can see the 50 line we looked at earlier, the gap between the two, the difference is not really very much. Whereas here, the gap between the darker blue EMA and the darker green SMA is quite a lot bigger. So that difference will depend on the time period you use. And then last of all, the EMA generally is just more aggressive because it has that faster acting characteristic, so it can help you to get into trades a bit earlier. So now you understand the two most common SMA and EMA moving averages, it becomes much easier to get your head around how all these other choices work. And essentially, they just use slightly different calculation methods on those weighting factors to make the moving average either more reactive or more smooth on this sliding scale. So for those of you that like to see all the gritty details, I will show the subtle differences between the other RMA, TMA, WMA moving averages to tease out how they treat those weighting factors slightly differently between each indicator. Although if you just like to start applying these concepts to your trading, then feel free to skip ahead using those chapters below. The next moving average variant is the triangular moving average, or TMA. And this is like the SMA of the SMAs, or in other words, it's double smoothed because we take those SMA values we just calculated and use those as inputs into the TMA, and it's just the average of those. So for example, if we wanted to calculate the TMA on day 10, we take the previous 5 days of SMA values and put that in the formula. So if we add up all of those, then that comes to 56,440. So that is the TMA value on day 10 for this chart. So we can now write that in here, and in a similar way as before, we now apply the same TMA formula and just work our way back for each day so we can draw on the TMA line. So I filled in all the values and now I've plotted them on the chart with the circles instead of the crosses for the SMA line, and now we can connect together the TMA moving average line through those circles. So if I connect that like so, and now you can already start to see the differences between the SMA and the TMA. And because, as we saw before, the triangular moving average is double smoothed, or it's an average of an average, then it responds more slowly to changes in price action. So there's kind of less noise, and the moving average line responds more slowly to spikes in price, which, if you look here, does make sense because the SMA line on top is going up sharply when we get these green candles moving up, whereas the TMA line, indicated by the circles, is moving up but more slowly below the SMA line. The next moving average variant is the weighted moving average. And this works slightly differently, where we allocate weights to the closing prices of each day. And the idea here is we're giving more emphasis to the price action from recent days. So if I'm looking at day 5, the weight value is 5, but the previous day is 4, 2 days back is 3, and so on. So each day that we go back in time, the weighting value gets smaller. So when you look at the WA formula, we're multiplying the price on that day multiplied by the weight. Then we add the price on the day before multiplied by the weight, and so on, which I've plotted here. And then all of that is divided by this formula, which factors in the time period. So if we just plug in all these numbers and work it through, that comes to 56,166.7. So that is the weighted moving average value on day 5. So we can now write that in, 56,167. And now we just apply the same formula and move forward one by one on each of the days. And now we just connect all of those points on our chart marked by the purple crosses. So connect those. And now we can see how the WMA differs to the SMA and the TMA. Now you can see in this area that the purple line is moving up much more sharply and quickly compared to either of the previous two examples. And that's because of the weighting factor, because the weights are being applied to give more emphasis to that recent price movement. So when we get this very sharp up green candle here and here, the WMA line responds much more quickly, it's much more reactive, and it spikes up faster than the SMA and the TMA. And similarly here, when price is dropping, you can see that the WMA line actually dips below the other two. And the other key thing to note with the WMA line is these weights can vary depending on the software you're using, since the formula allows you to input whichever weights are of your choosing. The next moving average variant is the volume weighted moving average. And this is quite similar because the formula takes the price on each day and multiplies by the volume of trades transacted in each candle on each of those days. Or in other words, it's using the volume quantities as the weighting factor. Instead of the previous example, we had manually chosen weights. So if we plug in the volumes and the closing prices into the formula and divide by the sum or the total of all those volumes, I've already written it out here. And if you work the numbers through, that comes to 55,574 with a rounding error. So that number is our volume weighted moving average here on day 5. And similar to before, we just apply the same formula, work our way down through the table, and we can calculate our VWMA for each of the periods, and then we could plot those onto our chart similar to before, although I'll show that in TradingView in a moment. Lastly, we have the RMA, or relative moving average. And this is actually very similar to the EMA, exponential moving average. In fact, it uses exactly the same formula. The only difference is the multiplier factor. So here, the multiplier is just 1 divided by the number of periods. So 1 over 5 equals 0.2 instead of 0.33 recurring we had before. So if you just plug in all the numbers again, using the same formula with the different multiplier, you get these values here for the RMA, which you can then plot those on the chart, like so, in the green line. Starting to get a bit crowded on here now, but you get the idea, like so. There's the RMA, you can just about see in green. And because this one has a slightly smaller multiplier, it changes slightly how much weight it gives to the more recent price action. So it's slightly dampened and it's not quite so reactive as the EMA. Now, there are actually several other lesser well-known moving averages, such as the HMA, or Hull moving average, which is pretty similar to the WMA with slightly different weights. There's the SWMA, which is the symmetrical moving average, which uses time and price weighting system. And there's the ALMA, which is the Arnaud-Legoux moving average, named after a Frenchman, which uses a Gaussian distribution for the weights. But the key thing is here, all of these different moving averages are just using different types of weighting mechanisms to try to smooth out the data, reduce the noise, and make the moving average more reactive to the price action, depending on your trading strategy and what is more important for you to look at. So before going through any further detail on the subtle differences of the calculations, let's jump back into the chart and see how understanding all of this can actually add value to your trading strategy, so you understand what to look for and why these different variations are important in different trading situations. It can be tempting to get carried away with all these subtle differences between EMA, SMA, TMA, WMA, and all the examples we saw on the whiteboard earlier. So just remember to focus on what you're really trying to do here. And, you know, that is applying this so you can make successful trades. So as a general rule, I just find use the EMA for trend and use the SMA for support and resistance levels, because it just works. The second thing is, it doesn't actually matter that much on all these technical tiny differences, because unless you're in very extreme periods of volatility, the differences can actually be quite minimal. So for example, I've actually added on the chart here the SMA, the EMA, the TMA, and the volume weighted moving average, all in these 4 different colors. And would it have actually changed what you would have done with the trade setup when this, you know, upwards trend started and price started clearly trending upwards? And, you know, all 4 of those moving averages are basically showing you the same thing. And then, you know, up the top here, when we've shifted into ranging price action, it's quite obvious. I don't think, you know, okay, you may have stayed in the trade slightly longer with the EMA, but ultimately, when you got this big dip down here from 70 to 60,000, you would have got out the position and locked in your profits from 40,000 down here, which was a gain of roughly, let's say, 50%. So does it really matter which moving average line you're using to, you know, maximize your profits? I don't really think so. The next point is that you have to remember time frames are really, really important with all these different moving averages, because yeah, if you're looking at the higher time frames like the daily or the weekly, or maybe, you know, the 4 hour, 1 hour, but when you start getting down to like the 5 minute or the 1 minute chart or something like that, this starts to become far less useful. So if I just adjust the settings here on all these moving averages, you have to check that you're on the same time frame as the chart being displayed. So you just go into the menu, click chart for each of these, and the last two already on the chart mode. So yeah, here you see now we're on the 5 minute, and it's arguable how helpful this is. I mean, price is just all over the place, you know, above, below, above, below. This isn't useful, right? So if you are going to use these, I personally would recommend to stay on the higher time frames. And then the last thing is, just because something like the SMA is very simplistic and not as advanced in the calculation method as, say, the EMA, that doesn't mean it's not useful. Because even though the SMA is basic, it can actually be self-fulfilling if everybody else in the market is using it. And when you hit those key support and resistance levels, people are aggressively buying or selling and defending those levels. The other factor to consider when choosing moving averages is the price source data we're using to input into the calculation. So all the examples I gave earlier on the whiteboard, we were using the closing candle price from the previous day. However, you can choose other inputs such as the open of the candle, the high, the low, or these different averages, the HL2, which is the high plus the low divided by 2, or the HLC3 or the OHLC4, and the calculations are here. Now, to show you on the chart, this is selected using the drop-down options here, where you will see all those different choices available. And just to give you an example of a difference, I've already added the SMA line with the same 50 time period, but here using the candle highs instead of the candle closes. So the highs are in this sort of turquoise color, and the candle closes SMA line is in the green. Well, obviously the candle high points are going to be higher than the closes for well, almost all the candles, and that's why the SMA 50 line in turquoise is, you know, tracking a little bit higher than the SMA 50 line in green for the closes. And if I change that from, say, high to HLC3, for example, and click apply, now you can see that turquoise line has moved, and that one's actually quite close to the closes. So how do you make sense of all those choices? Well, I've got a handy summary for you here. So one consideration is the smoothing effect. So the choices that use averages like HL2, HLC3 and OHLC4 tend to be smoother and less volatile, which is useful to identify consistent trends, but it may lag slightly compared to the other choices on the open, the close, the high or the low. Also, the HL2 and the other average ones tend to capture a broader holistic view of the market sentiment. So that's in terms of smoothing. And then in terms of sensitivity to price action, well, the choices like the open or close or high are going to be a bit more sensitive, giving you a quicker signal, but with a bit more noise. So overall here, when you're looking at those options, it's either more smoothing or more reaction and noise. And the ones HL2, HLC3 and OHLC4 tend to be smoother, and the other ones tend to be more noisy and reactive. Now, in my opinion, the high plus the low divided by 2 tends to offer the best balance overall between smoothing versus noise. Here, I've actually given you a table of all the different choices and what are the pros and cons of each one. I'm not going to go through all these, but if you'd like to pause the video, screenshot this and you can refer back to it when you may be testing the different options to suit your own trading strategy. However, something to be careful of, there's nothing wrong with learning how all these different tools and features work to give you more confidence in your trading. But I always say, keep it simple, stupid, or KISS, because you have to be careful that you don't start trying to so-called overfit the parameters when you're backtesting all these different kind of moving averages and data sources and so on, because you may backtest in a certain period and you get a very high profitability on your trading strategy, but then in the next week or month, the market conditions change and that backtested strategy is no longer effective because you've overfit the data. And the second thing is, I would say, you know, this does require a little bit of experimentation and testing, because you have to find what works for your trading strategy. You know, because you may be a trend-based trader, so you're going to use EMAs more. Or alternatively, you may be a swing trader and you're really interested when price hits those key support and resistance areas, and then you might use the SMA a bit more frequently. So ultimately, it all depends on what you want, what suits your style, and, you know, kind of trying to find the best of both worlds and using the different tools for what's going to benefit your profitability. So that's it on moving averages. I hope you found this useful and it provides you some value for your trading strategies. If you would like to learn more, then click on that subscribe button and notification bell down below, because next week I'll be doing another video on Bollinger versus Keltner versus Donchian volatility bands. So definitely check that out. Otherwise, I hope you have a good weekend. I'm going to get off the charts and go and have a beer and enjoy myself, and I hope you do too. I'll see you in the next one. Take it easy.